these are high quality assets. So Chip and my background working with private equity, working with reputable businesses, you're not investing in Joe Blow operating is drilling a well in the middle of nowhere, Hemp Hill County, that may or may not be a dry hole. That's not what we're offering. If you log in, you'll see publicly traded operators. You'll see, Slosson's one of the most prolific operators in the Bakken family office. They're private, but, have drilled, hundreds of wells kind of all across this area where we have this one deal. We're offering assets that I want to invest in, that Chip would invest in, and also assets that we would recommend, to a private equity type investor to participate in. And
welcome to An Ounce of Prevention, the podcast. At our Reese & Associates, we believe that an ounce of prevention is worth a pound of cure. Our daily commitment lies in informing our clients about legal risks without hindering their business objectives. As we like to say, we're in the business of building companies and helping executives sleep at night. So stay tuned. Maybe you'll learn something that'll help your business grow and thrive.
Welcome to An Ounce of Prevention, where we believe an ounce of prevention is worth a pound of cure. I'm your host, Rachel Reese. Before I introduce my guests, let's take a quick look at a recent case law update and talk about what it means for your business. Today's update covers Clifton versus Johnson, a royalty dispute decided by the Texas Supreme Court, and yet another double fractions case. In 1951, 3 people, including H.D. Cornell, executed a deed with Y.H. Holcomb. Someone hand-wrote royalty deed at the top, and the deed conveyed an undivided 1/128th interest in and to all oil, gas, and other minerals in and under certain tracts of land in Reeves County. The deed further stated that the grantee should, in future leases, receive only a 1/128th part. Immediately following that statement was a parenthetical stating 1/16th of the usual 1/8th royalty. For 70 years, the grantees and their successors received a 1/128th royalty until Johnson, a successor of Holcomb, claimed the deed provided for a floating 1/16th non-participating royalty interest rather than a fixed 1/128th. He argued that, in old leases, 1/8 sometimes meant the entire mineral estate, so the parenthetical of 1/16th of the usual 1/8 conveyed 1/16th of the entire mineral interest, rather than a double fraction multiplied together to reach 1/128th. Johnson sued the Cliftons, the successors of Cornell, in district court. The district court held that the royalty deed conveyed a fixed 1/128th interest for the amount paid for 70 years. Johnson appealed, and the appellate court awarded judgment to Johnson based on the holding in Van Dyke versus Navigator Group, another case involving double fractions, which you can hear a summary of on my friend Tim Powell's podcast from about 1.5 years ago. The Cliftons challenged the appellate court's holding, and the Texas Supreme Court accepted the case for review. On appeal, the question was whether the 1951 deed's use of 1/16th of the usual 1/8th royalty, parenthetical, referred to a fixed 1/128th interest, which the Cliftons asserted, or whether the deed meant to convey a floating 1/16th interest of the entire mineral estate, which Johnson asserted. The court first analyzed the double fraction issue. To determine if a grantor intended to reserve a royalty interest, courts look at the deed's language. In Van Dyke, the court recognized that the antiquated mineral and royalty deeds used a 1/8 as an official legal term to mean the mineral estate, and that if a drafter wrote 1/2 of 1/8, they meant to convey half the mineral estate, rather than the product of the double fractions, or 1/16th. Van Dyke directs courts to presume the use of 1/8 in a double fraction is purposeful and used as a legal term for the mineral estate. However, Van Dyke also cautions courts to be careful and explains that if a deed expressly uses provisions showing 1/8 to be a fraction rather than a legal term, then courts should multiply the 1/8 by the other fraction. The court held in favor of the Cliftons. It reasoned that the parenthetical explained the sum of 1/128th as multiplying 1/16th by 1/8, rather than intending 1/8 to be used as the term for the mineral estate. Thus, the Van Dyke presumption did not apply. Further, the court pointed out that without the parenthetical, the deed would simply state 1/128th, removing the double fraction confusion. The Texas Supreme Court reversed the Court of Appeals judgment and reinstated the district court's judgment, holding the 1951 deed conveyed a fixed 1/128th non-participating royalty interest in future leases. So why does this matter? These double fraction cases are becoming more and more common since the Van Dyke ruling, as litigants test the boundaries of what that ruling means for Texas law. We will continue to follow these double fraction cases and keep you updated on what they mean for your interests. That's all for today. I'd like to thank Frances Warden, a law clerk in our Denver office, for her help with this update. Today I'm joined by Chip Simmons and Adrian Macias from Tokenized Energy. Tokenized is a new online platform that's breaking down barriers to investment in oil and gas. All right, welcome to the podcast, Chip and Adrian from Tokenized Energy.
Thank you, Rachel. Appreciate you having us on.
Thanks so much.
Yeah, I'm excited to talk about this today. This is such an interesting strategy, and I think our listeners are going to be really into this. So before we get started, if you could just tell me a little bit about yourselves and how you ended up together at Tokenized.
So I started off as a partner in a land service company called Purple Land Management. We scaled that company up from 2010 to 2018, from one client in one basin up to hundreds of clients in every basin. And kind of across that journey, I met Chip, who was the CEO of Titanium Exploration Partners, a PE non-op group, kind of one of the first big non-op strategies with private equity capital in 2015 and 14 and 16. After Chip and I started working together, Aaron McCammett, who is our other partner in Tokenized Energy, best lineman I've ever worked with in 15 plus years in the industry, joined us with Titanium and is also with us with Tokenized now. So Chip, I'll kind of let you take it from there.
Yeah, Chip, I feel like he already did your bio for you, but if there's anything you want to add.
I've learned a lot more from Adrian than he has from me, so I should call him my mentor. But I was thrilled the day that Adrian called to see if we had an opportunity that was a good fit for him. So what I am is an upstream oil and gas guy. I've been private equity backed up until recently. So I've worked with three different PE funds, Reservoir Capital, Castle Lake Funds, and Barde Partners. And for them, we've deployed, call it $750 million in multiple basins. For Reservoir Capital, we had an operated strategy in multiple basins, but with the other two investors, it ended up sort of by default becoming a non-op strategy. We really didn't start with that, but for various reasons, that's what it became. Adrian came and pitched us on land services. I loved it. The way they were approaching it was somewhat unique. And I really bonded with Adrian. And so our relationship started that day and then grew over the years.
You guys have got some great deals on your website, but let's just back up real quick. For those of us who don't know, what is Tokenized Energy?
So Tokenized Energy at a high level, what we are doing is connecting oil and gas assets to on-chain capital markets. And we're doing that with two different products. One is what we would call an equity product, which we'll explain in just a minute. And those are the things that are live that we've started closing and are on the platform right now. And then we're also building a DeFi or decentralized finance product that we have not rolled out yet. So the equity products are more visible and more easily understandable for people.
Okay, well, let's stick with that one for a minute. How does the equity product work?
The idea was, why don't we take some of those deals that are really hard to get to if you're just sort of not in oil and gas, and even if you're in oil and gas, they're still hard to get into because they take giant check sizes. They take engineering, accounting, land personnel, multiple disciplines, legal.
And you usually have to bid.
And you usually have to bid to win the deal.
That's
in
right.
A very competitive process just to try to grab something that pays you, a monthly mailbox check. And so, the idea was let's just simplify access. We're really good at finding these deals. We have terrific network through Titanium, through Purple, through all these different entities we worked for in the last 15 years. And let's see if we can get a Lee County, New Mexico PDP deal under ConocoPhillips, a publicly traded operator, on the blockchain, and see if individual investors want to just, take a piece of the deal. And so at the end of the day, the thesis and our idea is, the same way, you look at your phone or look at your Schwab account and look at Tesla stock versus Amazon stock versus QQQ or whatever you're investing in, but kind of alongside that, have the opportunity to put capital into a Gulfport operated pad in Belmont County, Ohio, or a Midland Basin drilling deal under a publicly traded operator like Oventive, and kind of offer direct access to ground level deals for folks who otherwise would never have a chance to do that deal, and then provide the added benefit of saying, hey, if you can't write $1 million check or a $2 million check, but can write a $10,000 check or a $20,000 check, you can buy a piece of that deal without necessarily having to pass the hat at the country club, which is another added, barrier to entry for so many folks that just pull all the capital together to kind of get into some of these deals. So, Rachel, at the end of the day, what we're doing is we're just making these deals available to anyone who wants to participate.
And we've literally put it in the palm of your hand. But what we do is take, in these cases, non-op working interests, we put them in an SPV that owns only that asset. It's a pass-through entity. And then when you subscribe and we close the offering, you get two things from us. One is when you've opened an account, you've created and attached a digital wallet to your account. And all that does is tell us the address to which to send your tokens. So you get two things. You get a token that represents your equity interest in that SPV. And then secondly, when that asset starts to produce, if it's not already, by the time we close, then we send you your distributions in the form of a stable coin, which is a US dollar equivalent. We use USDC, which is the most reliable, trusted stable coin in the digital asset markets. So we use that one, but it's, one USDC is the equivalent of one US dollar. You can redeem it, convert it, do whatever you want with it. You can hold it in your wallet. You can reinvest it in our next open deal, which is what most people do.
Which is what we hope for. Yeah.
But we recently just made what we think is the first ever, on-chain distribution in respect of an oil and gas working interest. So we have since made a second distribution, and we're getting ready to make a third and a fourth on our other transactions. So it works great. People love it. It's much easier than going to the bank and keying up 40 different wires to your investor. So we love it from our perspective. It's administratively very efficient. It is virtually costless, and the investors love it.
That's great. So I want to back up a minute and talk about some of the barriers to entry that Adrian touched on and how you guys have solved those. So the first one, which I find very impressive, is that the properties that are listed on your site, like you said, you've done the due diligence, you've done the engineering, and so they're not going in and looking at, a seller's teaser and having to figure this all out for themselves, right?
That's right. We build a data room that has an investor presentation. It has our financial model. It has the underlying lease, the PSA, sometimes the title report. So we include all of that information. And it's a data room much like you would see in any M&A transaction on EnergyNet, let's say.
And the other one that I found really interesting is the app. So I am very guilty of, I wouldn't call it day trading, but it's sort of like extra money trading. So, you're like sitting at the dentist's office and you're in your Schwab account and you're like, oh, I just heard some news about XYZ company. Let me see what their stock is doing today,
Mm-hmm.
People can do that with your site. They can pull it up on their phone and just see what's for sale while they're sitting in the doctor's office.
That you can. I prefer the app. You can, of course, access it through the web if you want to, or through your desktop.
And you mentioned EnergyNet. I think it's important that we dispel one potential misconception. This is not an auction site, right?
It is not, and we built it intentionally with that in mind. Like we're not online bankers. We're not competitive with EnergyNet or with Inverus's mineral marketplace. This is, a deal is posted, the terms are set, and you can either invest in that deal or not. Yeah, we launched in the fourth quarter of last year with a small test investment because we wanted to get feedback on the platform. So we invited about 90 people, 52 of them opened accounts, and about 40 invested. And they agreed to do a survey and give us feedback, which was invaluable, but people were pretty gung-ho about it. And thankfully, there were no major technical issues in the use of the platform. And that really kind of put wind in our sails and encouraged us to keep going.
Although folks are buying into these deals, this isn't really like a typical fund. Adrian and I talked earlier about some of the distinct differences between investing in this versus investing in a traditional fund. Can we go into some of those?
I think, the biggest difference is if you log into the site, you might see 4, 5, or 6 different deals, and you can pick if you want to be in that deal and not be in that deal. You may say, hey, I think natural gas is going to, I'm bullish natural gas, data centers. You might have your own investment thesis that you've built over time, and you can decide, hey, I want to buy, Haynesville drilling deals, Utica gas deals, and kind of keep your investing that way. Or you can say, hey, I just want to kind of sprinkle money around, oil wells in the Bakken and, Permian, and maybe get some gas exposure in Pennsylvania. I think what's really interesting is an investor can build their own portfolio across any number of assets they want and then size their investment by asset as they so choose. Whereas in a fund, you write a check and, the manager makes, most of those decisions, if not all of them for you. And you kind of just sort of wait for your return and, read your quarterly updates or however it may work with you in that particular relationship. I think what we're building is something a little different. You're at the asset level. You might say, man, I just don't think that's a very good operator. I don't want to be in that deal. Hey, I think that operator, if it's EOG, I don't care where it is. I want to be in it. If it's Mewburn, I want to be in it no matter what. And I think that's really interesting. It's not just the ability to put capital, to work at the asset level. It's the fact that, the investors get to pick which deals specifically, which asset classes specifically they want to be in. And also if oil's doing some crazy price fluctuation, you may say, hey, I just want to kind of not invest right now, see what plays out with Iran. You can make that choice and not put capital to work. Or you can say, man, I really think, this is going to get even crazier in Iran. Price is going to spike. Let me get every dollar work I possibly can at the asset level. So, we really are the only place where you can log in and look at different kinds of deals and make your own investment decisions at the asset level. And then to go back to one other thing, Rachel, which is really not what you asked, but something I wanted to get across on the podcast, these are high quality assets. So Chip and my background working with private equity, working with reputable businesses, you're not investing in Joe Blow operating is drilling a well in the middle of nowhere, Hemphill County, that may or may not be a dry hole. That's not what we're offering. If you log in, you'll see publicly traded operators. You'll see, Slosson's one of the most prolific operators in the Bakken family office. They're private, but, have drilled, hundreds of wells kind of all across this area where we have this one deal. We're offering assets that I want to invest in, that Chip would invest in, and also assets that we would recommend, to a private equity type investor to participate in. And I think that is a distinguishing factor between us and some of the other, kind of ways to invest in deals, that you might see, in other places. It's just, hey, these are good deals. This is ConocoPhillips. This is Oventive. This is, Gulfport, in areas where they have infrastructure and expertise, and areas where, Desert Gold and Chip and Adrian also want to park some capital.
Yeah, it's not just, hey, we put anything and everything on this site. This has Chip and Adrian's stamp of approval.
That's right.
Absolutely. And we take a piece of every deal, and we generally take, this may not be the case forever as the deals get bigger, but as it stands right now, we'll take whatever the investors don't. I mean, for all of these deals, they've already been acquired, and we put them on there without marking them up. They're put on there at cost. So you're getting the same economics that we would have if we continued to own it ourselves and not put it on the platform. So, we're not, we want investors to have a good experience. We want them to make money, and we want them to reinvest, in our platform and stay within our ecosystem.
Okay, so let's talk about fees. First off, you all acquire these assets ahead of time. Do you have any sort of double promote markup when you're putting them on the site?
No, we put them on there at the cost that we acquired them. And so there's no markup at all. We do get fees for managing the asset. So we've it's done on a deal by deal basis, but so far there's been a 1.5% management fee and a 10% carry to compensate us for our efforts, and no one's had any issues with those economics.
Chip, those are great. Those are great economics.
We think it's very fair.
I mean, we're working cheap, but we also want people to make money. We want them to have a good experience, and we want them to come back.
And just for the audience sake, the standard is 2% and a 20% carry, right? It's a 2 and 20.
Yes.
That's right. So we intentionally did something cheaper than that in order to attract people's interest, because we didn't want that to be a roadblock in the way of investing. And one thing I would say is that, naturally with a platform like this, in the beginning, you're going to attract, call it retail investors, which we all are, whether you're accredited or not.
Mm-hmm.
You're still what the industry would consider a retail level investor. And we do have one institutional investor that's now taking a serious look at our platform as a way of expressing their desire to get more exposure to the kind of stuff that we originate. So we don't have any institutional investors now through the platform, but we think we will over time as more trust builds, not only in our platform, but in the concept of tokenization, because tokenization itself is actually a very big trend internationally. And it's one of the areas where the US is significantly behind in terms of adoption of tokenization. It's much more commonplace. It's much more ordinary for people to integrate into their daily lives in places like the Middle East and Asia than it is in the United States, where it still takes some explanation a lot of times to explain to people what it is that we're tokenizing, and explaining to them why it's a real digital asset that's attached to a real underlying what the digital asset people call real world assets.
Yeah, so let's talk about that, because I think I tend to agree people don't understand what it means to tokenize something. They don't know what a token is. So if you're investing in this deal and you receive a token in your digital wallet, what is that?
A token is, issued on a particular blockchain. In our case, we're issuing it on the base blockchain. And if you are unfamiliar with what blockchain is, said simplistically, it's sort of a decentralized, distributed ownership ledger that records transactions, in and out. And so it really tracks, ownership. Now, you can do a lot more with blockchain than just that, but if your audience needs a simple explanation of what it is and how it functions, that's what it is. So it's a decentralized, distributed ledger of transactions. And so when we issue a token on that blockchain, it's a token that's unique. It is tied to that specific asset, and the terms of that token are determined by something called a smart contract that's written on that blockchain. And that smart contract has the capitalization table for the SPV built into it. It also has things like, we're SEC compliant. We're doing these offerings under Reg D, which means they come with transfer restrictions. So those transfer restrictions are also built into that smart contract. So like everything these days, it's fully automated, and those terms are dictated by that smart contract. But in terms of the investor, him or herself, you'll receive a token that'll be named whatever the name of the investment is. You'll see it in your digital wallet, and there it is. It's much like owning, Bitcoin. It turns up right there in your wallet, and you can see exactly what you own. And then our wallets look a lot like the wallets or the accounts that you have at Charles Schwab. There's a transaction history of your deposits, your distributions, your investments. There's a list of all the assets that you hold. And then it's also connected to your actual digital wallet. So you can, click on links that we have in there, and you can you can either go to your wallet or you can go to the base blockchain and actually see what's called a transaction hash, which just identifies your transaction on the blockchain, and you can see exactly what time, when it was processed and how it was issued to you and in what amount. And it's all right there. One thing about the blockchain, it's very transparent. And so every transaction's right there for the world to see. You may not necessarily know the identity of the parties on each side of the transaction, but the transaction itself, there's no place to hide.
So that's a token. I imagine you guys also get the question of, is this cryptocurrency? Is that what we're talking about here?
Yeah, we get it all the time. And I think it's really important to understand, we didn't create the Chip or Adrian token.
You don't want the chip token?
Well, a mutual friend of ours, Corey Willett, will joke that she really wanted the Adrian token with like my bald head on like the coin. I think she may have designed a logo or two kind of on text, but that's not what it is. You're not buying a coin with nothing behind it. Really what the token represents is your equity interest in the SPV that entitles you to the same rights you would have had you invested in it through any other, sort of legal entity.
So it's basically a digital stock certificate.
That's exactly right. So, you're going to get your distributions and have all the same rights you would have otherwise. This is not, like I hate to use the word crypto, and Chip always says, it has negative connotations, which it does. A lot of people remember kind of those NFTs with like the monkey, and people were paying hundreds of thousands of dollars for those, several years back. We think some of the capital destruction that occurred when that was kind of the craze is what's leading to investors, in the blockchain sort of technology space to try to find assets that aren't that. They're trying to find things that actually generate income and revenue and yield. And that's a big part of why we think this can work. We're providing a token that actually pays you, real income and is backed by a real world asset on a monthly basis.
I mean, one of the things you see happening, Rachel, right now is that, this all started with Bitcoin. I mean, that was really the world's first exposure to distributed, ledger technology. And then came Ethereum. And then beyond Ethereum came, thousands of what are called altcoins that are truly just crypto vaporware that aren't connected to anything. And those things can be traded. They'll each have different sort of narratives, and all you really are investing in is a narrative. And I think most people that invest in that space, and we've done it too, by the way, but it was really our first exposure to digital assets was through crypto, and that's the way most people find it first. But what's happening now is that you've seen sort of a significant bear market in those altcoins, like Bitcoin and Ethereum have continuing use cases, and there are other projects that do have value. I'm not suggesting that there aren't, but one of the things you're seeing happen is really the professionalization of the space as people try to figure out what are the real use cases for blockchain and distributed ledger technology. And in my opinion, beyond Bitcoin, and you can have your own view of that, but in terms of using the underlying technology, the two biggest use cases, in my opinion, are stablecoins, and the other is the tokenization of real world assets, which is the part of the game that we're playing in by forming the Tokenized Energy platform. So stablecoins are becoming an increasingly common, form of payment. And what's happening is you're seeing, JP Morgan experiment with a JP Morgan coin for their deposits internally. Both NASDAQ and the New York Stock Exchange have announced tokenization programs. And so what you're going to see is tokenized, stocks and other securities that are going to be trading 24/7, and it's coming pretty fast. You're also seeing Venmo, PayPal, Visa, MasterCard. They're all developing payment rails that rely on distributed ledger technology and stable coins. So it's coming, and I think it's all going to be second nature to people. I think in the fairly near future, I don't know if that means 6 months or 2 years, but I think with tokenized energy, we won't be talking about a lot of the things we've talked on this podcast. People will take it for granted. They'll just look at us for what we are really trying to deliver, which is, access to opportunities that most people don't have access to. And the way we're delivering that access is via tokenization and blockchain. But it's somewhat like talking about how your car works. I mean, most of us don't really know and can't explain how a car engine works. We just know it gets us from point A to point B. So I think the time is coming pretty soon where we won't even be talking about that with tokenized. We enjoy talking about it and thinking about it and working on it, but the truth is, I think most investors don't come for that. They come for access to the opportunities, and they don't care how we deliver it as long as it works.
That was a great summary, and I agree with you. Soon everything will be tokenized, and we won't even be thinking about it anymore. But the access, the bringing down the barriers to entry that you guys are doing is really so interesting, and I'm so excited to see where you take it from here.
Well, we noticed that you opened an account. We want you to get in there and put some money to work, Rachel. There's one open on there now. We would encourage people to come get an account open and take a look at it. It is open just to accredited investors right now, but come take a look. The wells are actually being drilled right now. So the rig came a month earlier than we said it was going to in the material. So sometimes there's positive surprises.
Good news. Yeah, that's great. No, I did open an account. I really wanted to see how it worked, and it's so interesting. And then, of course, like all hell broke loose in my personal life. So haven't been back on, but maybe I'll have to do that after this.
Well, please do. We'd love to have you there and hope you have a great experience.
All right, guys. Any final thoughts for our audience?
No, just thanks so much for having us on, Rachel. Really appreciate making time for us.
Yeah. Come on to tokenizedenergy.com and check us out and reach out if you have any questions.
All right, guys. Thanks for being here.
Thanks, Rachel. Appreciate it.
The information and material in this episode is general information about our practice and firm and is for educational and informational purposes only. This information does not offer specific legal advice, and the use of this information does not create an attorney-client relationship with RRNA or any of its attorneys. The information in this episode, or any episode of An Ounce of Prevention, should not be considered legal advice, and persons should not act upon this information without first engaging professional legal counsel.
Thank you for listening to An Ounce of Prevention, presented by R. Reese and Associates. If you found this episode informative, subscribe to, rate, and review our podcast on Spotify, Apple Podcasts, YouTube, or wherever you listen to stay up to date with future episodes, case law updates, and breaking news. If you have any questions or are interested in learning what RRNA's outsourced legal department can do for your company, reach out to us at podcast@rreeselaw.com. That's podcast@rreeselaw.com. Follow us on LinkedIn or call 832-831-2289.